Dave Ramsey kind of argues against that point because he's looking at it strictly from the investment side, not from the protection side. There is some information missing from his message of what permanent life insurance can be.
Hey, Dave, I love you. I don't want to get sued.
Welcome into Impactful Conversations, stories and lessons for financial advisors. I'm your host, Dave Edgecombe. I've got 2/3 of our Crack Life team here joining me. We're going to talk IULs, but I'm going to be honest with you guys. I don't know where the hell this conversation's going to go. I had a plan because, and I'll set the stage for you guys, and you may be asking yourself, why the hell are we here to talk IULs? It's okay. I see this sort of content on the web. TikTok, Instagram, whatever it may be. And it's being presented from armchair financial advisors. Maybe they are financial advisors. Maybe they're just TikTok bimbos hawking a product of IULs and it gets clicks. But it's being proffered up as better than a Roth IRA from what I've seen. IULs.
Mm-hmm.
Before I dig into sort of the other side of the equation, I want just your guys' sort of a myth bust component to this, but what's your guys' thoughts on IULs for a consumer level?
They're both great. I think that's the short answer. And which one is better for what client is really dependent upon what their current situation looks like.
Both what?
Meaning a Roth IRA or an IUL.
So is an IUL to me, it felt like if someone was interested in an IUL, there always needed to be a second question. There needed to be a follow-up of, well, what's your situation? Like, does this make sense for you?
Of course.
Cut and dry.
Always.
But I think that's with anything.
Yeah,
right?
any financial instrument, you'd have to look into it, whether it's fixed product or variable, it doesn't matter.
Yeah.
There should be a lot of questions, more than two.
Yeah, absolutely. And it's not a one-size-fits-all solution, right? Meaning an IUL or a Roth. It's more than just one or two questions to figure out which direction you want to go.
So this is where it brings me to the other side of the coin, because in my research, I thought, wow, IULs are the greatest thing since sliced bread. I got to go research. I got to find out more about these. I went to YouTube, as one would do, and I heard the other side of the equation. I heard only shyster advisors are pitching IULs to their clients, and that beware. I mean, I got to imagine for a financial advisor to be called a shuckster and a shyster, those are damning accusations.
It's pretty insulting.
Yeah.
Pretty insulting, and it is the other side of the coin. It's the extreme of, hey, IULs are the greatest thing since sliced bread to IULs are a scam.
Sometimes it depends on what side of the table you're on, right?
What do you mean?
Maybe you focus on Roth conversions or doing Roth IRAs as opposed to IUL. So you're going to badmouth the IUL, or maybe your focus is IUL and you're going to badmouth the Roth IRA. Neither one is bad. They both serve a really great purpose for future distributions for a client on a tax-free basis. Which one is best for that particular client? That's where the advisor has to do their appropriate, asking of questions.
Yeah.
Which one does make the most sense? What's your time horizon? There's a lot of things that go into it.
Is there? I mean, what are those questions that someone should be asking
About IUL?
Yeah, I
think it's there's a couple of key questions when it comes to, and the one thing I do want to touch on real quick, the polarization of this is silly. There's a scam, everybody's a scammer, just like everything in our culture right now that's all online. We're not actually having good conversations about it. And to your point, Amount, about the questions about IUL and having a conversation, it's not a one-size-fits-all planning process. Like buy term, invest the rest, or everyone buy an IUL. That is a one-size-fits-all planning strategy, and that's not what we recommend advisors do. But our average size case is large compared to the industry. So a lot of the questions our advisors are asking about IULs when they're talking to clients and they're trying to figure out whether they're right for it or not is, what's your time horizon, right? Are you maxing out your 401k and your Roth options? What type of income are you making? Because I think, I don't want to speak for both of us, but I think most of the advisors that we're working with are working with clients that are exhausting all options for retirement savings. That be that a traditional 401k or a Roth IRA, they might be priced out from contributing to a Roth because of how much they make. And they're looking for alternative sources to generate tax-free interest and income down the road, right? And those are the folks that are really a great fit for an index universal life policy. Someone that is not trying to scrounge together for $200-$300 a month. Someone that has assets to put towards a long-term retirement strategy that happens to be an insurance product.
Well, that would be my concern, to go back to the other side of the coin about, what you see on social media and how it's pitched as, oh no, this is something that the average person should maybe DIY and try and figure out themselves. And that seems like a recipe for disaster, because one thing that I hear about in terms of IULs is this concept, and we've talked about this a little bit before we started rolling, of borrowing against yourself. And no, you get to be your own banker. Ooh, I've played Monopoly. I've been the banker before. I win when when I'm the banker.
Take a little off the top.
Yeah, skim. Yeah, I mean, who knows? My wife didn't talk to me for a week, but it's neither here nor there. But I've also played against somebody when they were the banker. And it can go both ways, and it can be a really unfair game, and it can get out of control really quickly. So I guess, first and foremost, this concept of borrowing against yourself and being your own banker. You hear that, and your first thought is?
I get concerned.
Why?
Yeah, same.
Mainly it's discipline, right? Treating a long-term insurance instrument as a bank is just not exactly smart, and usually it's from a discipline standpoint.
Is it because it's meant to be that long-term that if you purchase an IUL and then all of a sudden 5 years down the road you're looking for a loan on it, that's probably a recipe for disaster, right?
It very well could be, depending on how often you're wanting to take money out.
Yeah.
If you have a policy for, call it 5 years, and maybe you want to go buy a new car, and instead of getting a loan from a bank institution, you want to use an IUL. Can that work? Absolutely, it can work, right? Because you're still essentially earning interest on money that's borrowed. That could be a positive. But if money is going in and out, in and out, in and out, and then you lack discipline in that planning process, that's where I think you get in trouble with IULs, where you could potentially lapse it. You could put yourself in a position where it's upside down. You could put yourself in trouble. So we kind of talked about it before, but it's because of human discipline, I think.
Yeah. When I talk to our life insurance carrier partners, folks that have been around doing IULs for 20, 25 years, millions on the books, been in the insurance game for over 100 years. When I ask what's the biggest risk in an index universal life policy, it's not the product, it's not the cap rates or the participation rates on the index, right? It's not the mortality charges. The biggest variable in danger for an IUL's success is the client. Because we see that these IUL products, we see them every day. They work if properly structured and properly managed. It's like any instrument out there, right? And I think that's what Drew's talking about with discipline. Like, a lot of clients, life doesn't happen the way we think it's going to sometimes.
Yeah.
And that's where we can get in trouble with the be your own banker idea.
You just kind of touched on a phrase that I saw in my YouTube research.
Yeah.
Was this notion of, for an IUL to be effective and successful, it has to be structured correctly and funded properly.
Mm-hmm.
Can we shine a little light on what exactly that means? Because it rolls and it sounds great, but what does that mean to the average person?
So usually when we're talking properly structured, if we're talking about a long-term funding strategy that's more than 5 years, we're talking about a minimum, what's called a non-MEC face amount. All that really means is we're keeping the cost of insurance, mortality charges as low as possible, while still allowing a client to access the money via loan tax-free down the road, right? So the entire point is to keep that cost as low as we can, so that cash value inside the plan, earning interest, can continue to grow at the most effective way. That's number one. If we're funding for more than 5 years, we're going to want to use what's called an increasing face amount, right? Mm-hmm. Face amount option, where it's going to start out at the lowest possible place it can, and then it's going to grow over time as cash value inside the policy increases. So by doing it that way, right, at least during the funding process, especially if we're funding more than 5 years, that is how we ensure that an IUL is properly structured. But we have to make sure we're contributing that premium, every year, right? That is a set expense now. And we're going to pay that every year for X amount of years, however many years we agreed to pay.
Well, that's got to be one of the questions that the advisor has to ask the client is, are you aware that this becomes part of your expenses? This is baked into the bread, as we like to say, in terms of what your retirement strategy is going to look and feel like?
It should be.
Yeah.
And I think that's the issue we see oftentimes where a policy maybe doesn't look as good as it was advertised. It's because someone was supposed to pay, let's say, 10 grand a year into it. And all of a sudden, year 2, year 3, they've already pulled it back to maybe 5 grand a year, right? There's effects to that on the policy long term. I mean, that would be with any financial instrument.
Yeah.
So yeah, it has to be looked at as now a set expense that they're going to pay every single year. And again, long term, right? This isn't a short term investment. That's not what this product is. It is a long term insurance product. And if you don't structure it properly, you don't fund it properly, then yeah, I mean, there could be issues down the road. And I think that's what, when you do research, you're naturally going to see the horror stories first.
Oh yeah. Oh
right?
yeah.
Yeah,
Those
absolutely.
bad Google reviews.
I mean, that's how it always works.
Mm-hmm.
But typically when there's an issue, it's because there was disruption somewhere along the line in terms of how we were funding it, how the death benefit was created. Maybe someone took money out early and they didn't pay it back. So there's a variety of issues that you can come across, but structure and discipline has to be done appropriately, or maybe it wasn't the right call.
And that's part of the issue that I have with this like online discourse about insurance, like IUL, right?
Mm-hmm.
I think a lot of times folks are looking for something different than the traditional stuff.
Well, they're also looking for a cheat code. They're looking for the
Right.
easy way.
And that's- Yeah, and the IUL kind of gets put in that kind of cheat code section with like crypto. I've had advisors come up to me and be like, hey, yeah, I got this crypto guy. He's wondering if you should put money into an IUL or put it into Bitcoin. I'm like, dude, what is going on? Like,
what did
like,
you just
this
say?
is not. This is they're leagues apart. And I think one of the things that gets lost in this TikTok, Instagram, and there's we talked a little bit about it before we started rolling. It's like there's so much to cover in the IUL conversation that a 30-second reel can cover. But one of the things we lose is like, an IUL is just like any financial instrument out there. It is meant to be a part of a broader financial planning strategy. It's not the end all be all.
It is not.
And that's where I think a lot of folks get into trouble as an advisor is recommending, oh no, this is now your 401k. This is your 401k now, to somebody that's making 50, 60 grand a year in income. That is not what the best use of an IUL.
Yeah, I think that was the example that I saw was, well, this is why they're so bad, is you're selling it to a construction worker making 50 grand a year. Like, that's a terrible idea. Well, yeah, I think we can all agree on that's a poor use of it. Something that I'm interested in as I kind of get more and more familiar with this insurance world that you guys inhabit and love so much.
Burrowed right in like a tick.
Especially, so I sat down with Eddie Nolan, one of our sales VP here, and we talked about security benefit and their relationship with the Dodgers. That podcast is out. Like and subscribe. You can check that out on our YouTube channel. But I'm intrigued by this notion of liability and how insurance carriers, they're not going to take a bath on a product. They're not going to lose in that equation. So what's the math on an IUL so that they make sense for obviously the carrier, but also how they can still work for the consumer as well?
You're talking about like the cost to the carrier charges for the policy?
I mean, I guess fees.
What's the take?
Yeah, I guess. Yeah, you got a take here?
What's the take for the life insurance carrier itself? Because it's not a charity. I don't think anyone that's in business is running a charity. I think anybody listening to this that owns a business knows that.
Well, and the fees and commission component of it was one of those, one of those strikes against it was they're not doing it for free. They're not doing it out of the goodness of their heart.
No, I mean.
And they're not cheap.
If we typically look at it versus other instruments, right? Like, so a well-structured IUL usually long-term has a cost signature of about 1.25% as a percentage of cash value. Now that's going to be in line with like mutual funds and stuff like that. But unlike a mutual fund where that fee is going to advisory services, right? We're paying this fee to a life insurance carrier for that death benefit protection we're buying as part of the instrument. So that 1.25% long-term fee as a percentage of cash value is buying that death benefit. But I'm not going to act like it's like the first 10 years of an IUL are the most expensive years of the plan, period. Sometimes you'll see costs as high as, 10, 20%.
Mm-hmm.
And that's because a lot of the liability for the carrier is really high in the early years. We're not putting a lot of money in. That death benefit's going to be a lot higher than what the cash value is. And so the carrier's going to take a loss, right, on the money in and money out of the plan, right? So a lot of those fees are front loaded. And the commission is also front loaded usually, which is great for financial advisors from a cash flow perspective, but it does get those TikTok, scam and all caps kind of titles on videos, because you can point to that and say, well, this guy's making a front loaded commission on you.
And that's only just looking at a snapshot of the full life of what that vessel is supposed to be, right?
Yeah, and that part of it kind of neglects the fact that over the next 10 years, fee-based planner is going to make a point and a half on their client's assets as a percentage of that value. And the insurance guy is just getting all that up front. They're going to make about the same over the next 10 years. It's just a matter of how quickly they get it, right? So the commission thing, when you actually look at the numbers, it's very much similar to what an advisor would make on like a managed portfolio.
So I know when we first started, we weren't going to talk about Dave Ramsey, but he was sort of the other side of the coin.
Mm-hmm.
And he had hot takes, and he was throwing out the shysters and all that. But one thing that he said that I kind of wanted to bring to you guys was this concept of combining insurance and investing, and what the dangers of that are, but also what the values of that are. Because it seems like it could be, those are meant to be two different things, security and growth. Does an IUL kind of combine those two things, and what's the danger of that?
Well, it certainly can. So there's nothing wrong with term insurance. But when you look at the big picture, right, life insurance is purchased initially for the death benefit, first and foremost for the death benefit. Term insurance expires, right? So why would I be buying a temporary product for a permanent problem, right? So I think that's the problem I have with buy term and invest. The difference is I would argue, or could argue, that we always have an insurance problem, right? You're married, you have children.
Mm-hmm.
If you have a 20-year term and it expires and you pass 25 years from now, what kind of position does that leave your family in from an income replacement standpoint, protection standpoint, paying off of debt?
Mm-hmm.
So your term insurance would have done you no good in that case. It's just money that was flushed down the toilet, essentially.
Yeah. So
there's nothing wrong with term insurance for maybe short-term liabilities, but death is a permanent issue. So permanent insurance is very, very important. And Dave Ramsey kind of argues against that point because he's looking at it strictly from the investment side, not from the protection side. The invest the difference part, I always go back to the human element part of it, which we kind of discussed earlier, which is discipline. So if I'm buying term and I'm investing the difference, am I truly investing the difference? Am I that disciplined to take that money and put it into an instrument that is going to grow over time for me to use in my retirement years? And I think he ignores that part of it. So again, there's nothing wrong with saying term insurance is the option, but it doesn't solve the long-term need that someone has from an insurance need perspective. Now, from the investment side of it, we will never sit here and say that cash value life insurance, IUL, whole life, whatever, is the end all be all. That is not your only strategy that you've got to use, but it can be a very good complement, right? When you look at sort of the rules of money, tax-free money is better than tax-deferred money, right? So if I'm able to pull money out of a tax-free vehicle in my retirement years, is that more beneficial for me from a taxation standpoint than an annuity, a 401k, an IRA would be? Of course it is. But it's not the end all be all. It is meant to be a complement. So I think there's a little bit of missed, I don't want to say interpretation, but there is some information missing from his message of what permanent life insurance can be. So I think he looks at it from people saying you have to do this as your full financial plan.
Yeah.
And that's not smart.
And I think that criticism, like Dave's criticism, hey Dave, I love you. I don't want to get sued. So
he's a fan of the show.
Good. Fan of the show.
He is one of Do we have a Patreon?
Not yet, but now we have to. Thank you.
But I think I think it's a fair, like Dave clearly has personal experience with this. Like he must have run across clients that bought policies that weren't properly structured. Mm-hmm. And I think it's a good thing to be aware of that bad design. I had a conversation with an advisor recently. They had bought a policy with a carrier that will not be mentioned by an advisor that will not be named. And they went out, and it was basically a cash grab for the advisor, right? It's all those things we teach against when we're talking to advisors. It was structured with a high death benefit, minimally funded, so it didn't really have an opportunity to grow and do what it's good at, right? And I think part of a financial advisor's job, and this was clearly just an insurance advisor, right? Just a person that was only focused on selling as many IULs as they could to whoever they could.
Yeah.
But part of the financial advisor's job is to, basically structure every one of their tools they're using in the best possible way to help it win, help it do what it's good at, right? So I think Dave's saying, IUL is bad. Like if it's improperly structured, absolutely. It absolutely is it will not accomplish what these folks online are talking about.
Yeah.
But if we use it as a companion to all these other tools we have in our toolbox, as a volatility buffer when our other accounts that are in the market are down and we can pull from a principal protected tax-free source, that's where it can really win. And I think it just comes down to doing a full financial plan.
So the reason I hinted at why we sat down and why we talked IULs was, yes, the noise and how polarizing it was. But from my vantage point, it felt like the sort of topic that an advisor would much rather control the narrative in terms of how their clients and prospects are hearing about IULs. If you're an advisor, would you rather have your client ask you about an IUL, or would you rather ask them about an IUL? Does that make sense? Is that sort of dynamic of, you don't want someone coming in there being like, hey, I saw this on TikTok. Why am I not doing this?
I mean, reactive messaging is always worse than proactive messaging. When we're reactive, we're kind of not able to set the terms for that conversation. And so like anything we're talking about when it comes to retirement, we should be that proactive voice out there to our clients. That's the whole point of all the marketing we do here at Impact is I want my message to hit my clients and future prospects first before everybody else out there in the market.
Couldn't have said it better myself.
That was actually pretty good.
Yeah, pretty succinct.
Did I cook?
Yeah, I believe
really
you
good.
were cooking.
Did you
right.
say succinct when in reference to me?
Yes, I know.
Whoa.
It didn't feel right saying
Whoa,
it, but
that's
it
crazy.
felt warranted.
Yeah.
That was very well done and a great place for us to kind of wrap this up. So, guys, thanks for taking the time. I know that IULs don't jump off the page as being sexy, but again, I think there's maybe not misinformation, but there's a lot of noise and a lot of chatter. And so I think this provided a lot of clarity and context, really, which is what a lot of that online discourse is really missing. So, guys, thank you. Thank you for watching as well. Our YouTube channel, a great place to start if you're looking for more ways to grow your financial practice. We got Selling with Stories, House Rules, and we've got testimonials from some of the advisors that work with us and these lovely gentlemen right here who do an outstanding job. You guys are having a massive year.
It's been incredible. Yeah. We've been blessed.
Potentially best year ever.
Blessed year.
What an effing ride.
Mm-hmm.
Well, it's been great to see, and you guys have done an awesome job, and I think our advisors would echo that same sentiment. So once again, thank you to you. Thank you for watching. Like and subscribe, and we'll see you next time.